This, of course, implies that you may also not be able to deduct those contributions. Specifically, if you or your spouse is covered by a workplace retirement plan and your income exceeds limits set by the IRS, your deduction for traditional IRA contributions might be limited, or you might not be able to deduct those contributions at all. We can help you determine whether you qualify to deduct traditional IRA contributions. If not, then unfortunately, your IRA contributions might get doubly taxed. That is, taxed when you put them into the account and taxed again when you draw funds out of the account in retirement. So does this all mean that if you don't qualify to deduct the contributions, having a traditional IRA just isn't worth it? Not necessarily. Even with double taxation, an IRA can provide tax-deferred growth of account funds. Ordinarily, if you receive investment income like interest or dividends, you must pay tax on that income in the year when you receive it. With an IRA, those returns just pump up the account balance with no tax impacts until you take distributions. Now, although federal income tax on funds you contribute to a traditional IRA may be deferred for a very long time, the tax code is generally set up to prevent taxpayers from deferring tax forever. Therefore, once you reach a specified age, typically in your 70s, the IRS will usually require you to start taking money out of your traditional IRA, whether you need it or not. These mandatory withdrawals are called required minimum distributions, or RMDs. The amount of your RMD each year is calculated based on your current IRA balance and your age. We'd be happy to help with those computations. Like all distributions from traditional IRAs, RMDs are generally taxed as ordinary income, which is a bit of a headache if you have no need for the withdrawal. Fortunately, the IRS does provide a workaround. If you genuinely do not need your RMD for a particular year, you can instruct your IRA manager to donate those funds directly to an IRS-approved charity. Making such a qualified charitable distribution, or QCD, may eliminate federal income tax on the RMD. Just make sure to follow all the IRS rules governing QCDs. In essence, a Roth IRA is the mirror image of a traditional IRA. You cannot deduct contributions to a Roth IRA on your tax return, so you generally must pay federal income tax on that money. However, you will not need to pay federal income tax on money you withdraw from your Roth IRA in retirement. Here's a side-by-side look at how traditional and Roth IRAs compare. Summing up, while a Roth IRA does not allow you to defer tax on your contributions to the account, it can provide both tax-free growth and tax-free retirement income. Analysts often say that a Roth IRA is taxed at the front end, whereas traditional IRAs are taxed at the back end. Another key distinction between these two IRA types is that since you have already paid tax on the money you contribute to the account, a Roth IRA generally does not have RMDs. The next question to consider is whether you qualify to establish and contribute to a Roth IRA. The IRS has strict income limits for Roth IRAs. Generally, if your income for a year surpasses the limits set by the IRS for your filing status, you cannot contribute any funds to a Roth IRA that year. If you violate this rule, your account will lose its status as a Roth IRA, and you may face other tax penalties as well. Therefore, if your income is relatively high, You may wish to check with us before opening or contributing to a Roth IRA. Based on the income limits for Roth IRA contributions, it might seem like these IRAs are simply unavailable to higher income taxpayers. Once again, however, IRS rules allow for a workaround.